overall, I'm exceedingly bullish. I would look at any dip to be shallow and short term. I would look for 2000 to become support, major support at 1960. In terms of levels of resistance, it will have to challenge 2040. If it goes beyond, and that's a double top, goes beyond that, 2080, and then the all-time record high is touching $2,100 per ounce. So I would think that it should go through at least one, if not challenge two of those levels, meaning 2080, before traders step in to pull profits.
Gold prices have surged approximately 8% since the beginning of the conflict, driven by Hamas militants' attack on Israel. The rise in gold prices reflects investors seeking refuge in the metal, considering it a safe store of value during geopolitical turmoil. As of late October, the spot price of gold has surpassed the significant $2,000 level previously witnessed in May amid the aftermath of the U.S. regional banking crisis. It has stabilized within the range of $1,980 to $1,990 per ounce, indicating an impressive increase of nearly 10% over just 1 month. Gary Wagner, editor of thegoldforecast.com, reflects on recent market trends, noting the lows experienced at the end of September, which was around $1,840. Despite a minor decline to around $2,000, Gary maintains an optimistic outlook, anticipating potential retracements from traders capitalizing on profits. Notably, $2,000 might now function as a strong support level, a departure from past instances where it struggled to maintain itself above this threshold. Recently, gold futures have surged by 3%, breaching the psychologically significant $2,000 per ounce mark on Tuesday. This action marked the highest daily close of November. Any movement surpassing $2,006.37 per ounce this week would signal the highest weekly close since the spring. Discussing global central banks' monetary policies, Gary contrasts the Federal Reserve's aggressive stance with signals from the European Central Bank, ECB, hinting at potential rate cuts. He highlights how these factors, combined with geopolitical tensions and the likelihood of limited further rate hikes by the Federal Reserve, could solidify gold's position above $2,000. Additionally, he suggests that this environment might propel gold to confront and potentially surpass higher technical resistance levels, signifying a potential shift in the precious metals market dynamics amidst evolving central bank policies and global uncertainties. We will present clips from Gary Wagner's interview with David Lin. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
At the end of September, that's when we hit the lows at around 1840, and the numbers I'm giving is basis February gold that became most active a couple of days ago. And then we went into what I'm calling the October rally, which is when there was a conflict in the Middle East, taking gold from about 1840 up to $2,019 before retracing slightly. Now it's back up today over $2,000, even though it is down about $8, it's still sitting at roughly $2,012. I'm extremely bullish. We could get any kind of a pullback in terms of profit taking. I believe that 2000 will become the new level of support. I want to see that remain that way because so many times we've seen it break above that only to break back below. But I think that that could be a good area of support. And if in fact we do see it move higher, I expect it to challenge about 2040. The shorter term traders pulling profit, to be honest, on the occasions previous to this occasion, there weren't so many multiple factors in play. Right now we have geopolitical unrest in Ukraine and in the Middle East. On top of that, we have the Federal Reserve's expectation that they might in fact have concluded with rate hikes. We'll have to see. The last time Powell spoke, he kind of spoke through both sides of his mouth, saying that I really am hoping that we don't raise interest rates again. And then he buffered that by saying, but if the data suggests that it's necessary, I won't hesitate to pull the trigger. Of course, you have multiple Fed members, both dovish and hawkish, some recommending that they do one more rate hike, others saying that enough is enough and we've gone high enough. I mean, when we think about it, The Federal Reserve in March 2022 had their Fed funds rate between 0.25%. It's now 5.25% to 5.5%. So they've been exceedingly aggressive. The ECB has already said that they're done with rate hikes and they are beginning to talk about rate cuts in April of next year. And so that component has really taken some strength into gold and allowed it to maintain above the price point. And that's why I think that breaking above 2000 now, because of the geopolitical concerns, as well as the fact that the Federal Reserve, if they do raise rates, it might only be one more at 0.25%, and they could in fact be done with that cycle, bodes well for gold, at least holding above 2000 and maybe challenging some of the higher levels of technical resistance.
Federal Reserve officials, as revealed in recently released minutes on Tuesday, indicated a reluctance to reduce interest rates soon, given that inflation continues to surpass their target levels. Gary examines the intricate dynamics within the gold market, attributing the momentum to the Federal Reserve's shift away from pursuing interest rate hikes. This shift materialized when the Federal Reserve halted its rate increases for the second consecutive FOMC meeting and hinted at a significantly low likelihood of a December rate hike. According to insights from September's dot plot, Wagner underscores the anticipated focus on potential rate cuts, which are projected to materialize around the second quarter of the following year. Although gold typically flourishes amid high inflation, active central bank policies raising interest rates might counteract gold's upward trajectory. This trend occurs as capital moves from gold to fixed assets, offering higher yields and perceived safety, such as government treasuries or bank interest rates. Furthermore, the staggering national debt, now surpassing $33 trillion and nearing $34 trillion, presents a unique challenge, as Gary emphasizes. Servicing this colossal debt, particularly regarding interest payments, has reached levels nearly on par with annual defense expenditure. This unprecedented debt trajectory deviates from past scenarios, raising concerns about its sustainability. Let's get back to the interview.
I am not surprised that gold continues the momentum because as the Federal Reserve pivots to interest rate hikes to the pause, which is now the second FOMC meeting in which they have not raised rates, and such a low probability that they will raise rates in December, that is the first sign that traders are looking for to anticipate that cycle is over, the rate hike cycle. If in fact they have now concluded the rate hikes, then it's simply a matter of when will we see rate cuts. According to the last projections, which would be September, the dot plot, we're looking at about the second quarter of next year. And now there are some analysts out there that are suggesting that they will start cutting it sooner. The key difference to me is the budget deficit and the overall deficit of the US budget, which is now at about 35 trillion. We have seen occasions when interest rates were at this level or much higher. However, we've never had this kind of debt to service. And from what I read, the trajectory that we are on right now in terms of just servicing the interest on the debt at that level is almost equal to the Defense Department's expenditure on an annual basis. That's never been the case. And so for that reason, I believe this is a different scenario than what we have seen in the past. When the debt is this high, the government has to service that debt. The interest on that debt is so high that, according to Chairman Powell and even Janet Yellen, they have both said that this level is kind of unsustainable for an extended period of time. And when the interest rates go higher, the service on our national debt increases tremendously. There's a huge difference if your interest rates are sitting at around 0.5% or 1%, or at 4 and 5%, which is the case right now. And so that's why that is unsustainable at this level, because the national debt is at such a high level, a record level, I should say. Gold does do very well during periods of high inflation. If there is active central bank monetary policy that's raising rates, that works against gold. That's counterintuitive because gold does not yield any interest And because of that, as interest rates go higher, yields are higher in banks, and so fixed income is higher, and you get dollars moving from gold into fixed assets that have the safety, whether it be US government treasuries or interest rates in banks. And you have to add that variable, but that's a correct assumption. But you have to add in what are the interest rates doing at the same time.
Gold is trading above all three moving averages and is back above the 23.6% Fibonacci retracement level at $1,972. The recent $2,009 high is the next target for bulls. What are your thoughts on the future price movements of gold and silver? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.